Soaring gas bills are weighing heavily on both families and manufacturers who risk going to the wall. Qenos is a manufacturer in New South Wales directly employing 600 people. Gas is vital both to making its products and to running the factory. Businesses like Qenos have been lobbying hard for better deals from Big Gas.
Well, with the rising domestic gas prices we're seeing here on the east coast of Australia, there's a lot of manufacturing plants, gas-intensive manufacturing, which are at risk of shutting. So we heard from the union who represents a lot of the workers, from manufacturing businesses. We're talking about thousands of people, potentially up to hundreds of thousands of people, of jobs at risk should gas prices be sustained at such high levels.
The problem seems to be less about gas supply and more about gas prices, both for Aussie homes and manufacturers. Prices fell back when the government announced its new intervention powers, but they've been creeping back up. This week, crossbench MPs have told the government if it wants support for its full income tax package, it needs to impose a domestic gas reserve in the east and use its big stick to force gas companies to bring down prices. But the big fellas, Santos, Shell and Seven Group, have all said this won't solve the problem, but it will damage investment and push prices up. Here's their chief spokesman, Damien Dwyer.
You put in place an additional mechanism, you put in place an additional intervention, and you risk driving the very outcome that you're concerned about.
The regulator, Rod Sims, at the ACCC has been very interested. At first, he wanted to see gas prices linked to low international prices. But Credit Suisse gas analyst Sol Kavanagh reckons the regulator is now moving the goalposts.
The problem we saw last year is LNG spot prices more than doubled. And all of a sudden, the very metric that the ACCC put out there would actually result in gas prices which would put jobs at risk and manufacturing viability at serious risk of closing down. And so we started to see earlier this year Rod Sims come out and actually suggest, notwithstanding where the LNG prices netback pricing may be, it would be a real shame to see manufacturing shut down, for example, if they can't get $7 gas, despite $7 gas being well below where the netback was last year.
Out on the high seas, it's hard to forecast prices. Ever cheaper US production, but then trade wars. Demand for gas is also rising to replace coal and in new sectors like transport. A legend in the gas industry, over from Houston, is Martin Houston. And Houston from Houston sees gas prices in our region going up over time.
I do. I mean, I think the world will become tight again, certainly in our view, in the early 2020s, in which case we'll see the softening become a hardening of prices, and buyers will react accordingly.
What everyone can agree on, gas players, manufacturers, even unions, is that gas moratoriums in Victoria and New South Wales, which imports 95% of its gas, should go.
More supply from more suppliers. That's the best way to put downward pressure on prices.
And this sort of curiosity that, states that don't allow exploration or fracking or whatever it is that
are the ones that desperately need it.
Exactly.
On Friday, headlines splashed that Santos's controversial $3 billion Narrabri project would be given the green light by government by Christmas. Narrabri has been targeted by anti-gas campaigners, but a Santos commitment to deliver gas domestically, locking in forward contracts with manufacturers like Qenos, and at lower prices than any LNG import terminals yet to be built, is building political support. Elsewhere, there's almost a de facto domestic gas reserve evolving anyway. The Queensland government is only giving exploration licences for domestic gas use. Players like Beach and Cenex only supply the domestic market. But a hard intervention would be a blow for the sector. Interesting then that this man, Andrew Liveris, former chair and global CEO of manufacturing giant Dow Chemical and chief lobbyist for lower gas prices, slipped into Australia this week. The week crossbenchers got vocal and Narrabri got closer. It's all hotting up. Now, in the gas business in Australia, Shell Australia is bigger in size than all the Australian-listed gas companies, with Gorgon, the North West Shelf and Prelude, and in the east, QC LNG at Curtis Island. Now, in fact, the new Prelude floating LNG plant has just come on stream in the last couple of weeks.
Zoe Yujnovich, as well as being Shell Australia boss, is also chair of APPEA, the gas lobbying group. So what does she make of the East Coast gas crisis? Or Is it a jobs crisis?
Firstly, I think it's important we go back and remind ourselves that it's very clear to us without a healthy, functioning domestic market, our licence for export is clearly going to be in jeopardy. So we're spending an enormous amount of time really solutions-focused on how we can best work with our customers and our manufacturers to make sure that we can make this a sustainable approach.
You actually support the government's domestic gas intervention mechanism. It hasn't been used yet. Do you worry, though, that it might be used because the regulator is clearly concerned about gas prices edging up again?
Yeah, I think what we have seen, and most of the reports that we're seeing released, whether it be from the Australian energy market operator, shows that there isn't a shortfall of gas in the market. And certainly our observations as we work with customers, with C&I customers in particular, is that we are seeing contracts now coming into place. Yeah. Indeed. And so I think as we work with manufacturers on those contracts, we're seeing that there is multiple offers in the marketplace, and we're starting to see contracts that are being signed for multiple years in duration. And so I think what we would argue is that indeed we're seeing the market function, there's more competition in the marketplace, and we're starting to see manufacturers at a place where they're willing to contract over multiple years.
I was pretty interested in some of the comments you made in your speech about some businesses, manufacturers, are actually agitating the government for intervention. You talked about inked-in tactics. What do you mean by this?
Well, of course, all companies are going to be making sure they look after their own shareholder interests and the viability of their future businesses. And indeed, of course, that's a normal behaviour as we start to see people coming out, whether they're contracting or indeed advocating for intervention. I think what's important to us is that we understand what is the real issues at play and how we make sure that the facts are in the right hands for those who, whether it be the ACCC or indeed with the Minister who might be making choices around the domestic gas.
You obviously think there's some gaming going on the manufacturing, the business side here.
Well, certainly we do know in contracts that we have in the market that many of them, particularly legacy contracts, are at a significant discount to prevailing prices. So that's not unusual, and indeed that's a risk that we will bear, knowing that we will contract in a relatively volatile market over multiple years. And so I think it's just a matter to make sure that we recognise that sometimes when you get into the market, you'll get lower prices or higher prices, making sure that's taken in a much more holistic nature than what we see today.
I'm pushing you here, I know, but do you think these companies are being called out? I mean, there was talk about the Incitec Pivot deal, which took a long time to actually come to fruition. There was also your sale a while ago of gas to AGL, who then actually on-sold it. Are these the sorts of examples that we're talking about?
Well, I think what we would say is we spend a lot of time looking at how to increase the efficiency of our own operations. And indeed, for manufacturers, some are highly exposed to input prices like gas, but indeed there will be many variables that will be contributing to their competitiveness and importantly, the resilience of their businesses over time. And so our conversation has really been around how do we go about minimising the risk associated with volatility on some of those inputs. And indeed, we'd encourage them to talk to us about how we can create pricing structures that help them to manage that volatility.
But do you think manufacturers should be subsidised by big gas? The regulator has recently said, I think, that it would be a shame if manufacturers failed at a $7 gas price.
Indeed, it's our observation that there has rarely been a circumstance where there has been intervention by governments in the market where the markets have ultimately been better for that intervention. And so we go back to the principles around we will always see peaks and challenges. Energy, of course, is not immune to that. How do we manage in a way that doesn't prevent interventions today that will fundamentally actually make this situation more challenging over time? So a case in point, if we do see an intervention on price, then the incentive price around what might be now available for further investment to bring those molecules to surface and ultimately to deliver to customers could indeed be compromised. And so we have to always be really careful of those unintended consequences of any short-term interventions.
So Credit Suisse's Sol Kavanagh today was arguing that the regulator seems to be moving the goalposts. He started out by linking the domestic price to the net back price, the all-in cost price, and now moving more towards an absolute number thanks to political pressure. Now, what will that do to international players like yourselves, who obviously have capital that they can put anywhere around the world?
Yeah, indeed. I think firstly I would say on having greater transparency in the market is often a good thing. It does ensure that people are held to drive the right competitive offers for customers. And so transparency is often a great place to start. The challenge, of course, is that whenever we focus on any singular number in an industry that has many different factors that play into it, that it's really hard to get a singular number correct. But the directional sort of transparency is certainly one we encourage. It will help open debates like the ones we're having around what is the right marker, what is the right benchmark. To your comment around how then mobile is capital, well, we know that capital is incredibly mobile, and we'll be looking for those projects that can offer them the best risk-reward profile. Indeed, we need to be careful that we don't create any significant risks related to regulatory intervention or indeed sort of more sovereign challenges as a result of some of these conversations which are currently taking place.
Now, Zoe, what about Prelude, your floating LNG, which came on stream literally this month? It must have been very exciting for you guys. It is 3 years late, though. Are there any lessons from all of this?
So firstly, it is something that it's very rare where you get an opportunity in the roles that we have where you can be part of something that's just so momentous, like the first cargo of Prelude. And so I can start by saying I'm just so proud of the broader team in having brought what is a very innovative technology to the market in a way that's been safe and commissioned and now decreasing the risk related to the way in which the project has been executed. So it's an incredibly proud moment and one that you very rarely get the privilege to be involved with in a role like mine. Indeed, of course, the floating LNG concept is now something that in time I think will tell the full story.
Will it be repeated, do you think?
Well, we have seen most recently a new announcement that says that there are others now also looking at floating LNG. And so I think that there is 2 in operation, 1 more most recently announced. I think it'll be a story that'll get told with the benefit of, I suspect, many more years ahead of us.
Zoe, you've been part of the CSIRO Australian National Outlook. That's a big commitment of senior executive time. Your views on the energy future. We've just seen AGL take a look at Vocus. Now, that isn't coming off. But elsewhere in the world, Shell is looking at energy retailers in Britain. I think you've got Shell Australia now. I'm wondering if we're going to see something similar over here, that Shell might be, for example, interested in something like an Alinta.
I think what we do see, and it's interesting, we find whenever we have a global strategy announced which talks about how the company is likely to transition and evolve over time, we often see in various jurisdictions around the world some local speculation around what that may mean. And of course, we're not immune to that in this domain either. We do see, if you think of Shell more holistically, around both driving value for our shareholders, but also how we play in the energy transition that is before us, along with how we work with our communities in developing resources successfully, a real focus on how we transition from, say, molecules into electrons. And so I think that that is something underway. How exactly Shell Australia may feature in that is still to be determined. I can say, of course, that we've been talking a lot about a 120 megawatt solar farm that we have in Queensland. That'll be part of the process in which we look at electrification.
But I think, again, in England, through Shell Energy, you're actually offering customers green electricity, aren't you? So is this something that you might also be looking at doing here?
Over time, I think the aspiration that we have, both in line with our net carbon footprint and how we look at more broadly how our products are being used and consumed around the world, I do think that we are interested in how electrification plays a role. But indeed, we still have significant businesses in gas and in conventional oil and gas and in other industries, all of which are really important for today's cash flow and contribution.